Welcome to another episode of Talking Shop with IG. If you're tuning in for the first time or a seasoned market enthusiast, then you found the perfect pod for you. Ever wondered what it's like to be a fly on the wall of the IG trading floor? Then you're in the right place. We're here to give you the insider view from the premium client desk at IG from our head office in London, and in each episode, we will break down complex trading concepts into clear, actionable insights. We explore the latest market trends, look at interesting trading strategies, and offer perspectives from the conversations that we're having with our top clients every single day. Our goal is to make trading approachable, engaging, and hopefully do so with a few laughs along the way. So let's dive in and let's talk some shop. Welcome to a new season, a new year of Talking Shop. It's 2025. It's taken us a few weeks to get back in the swing of things. New president in the US, same hosts. I'm Luke. Welcome back to Talking Shop. I'm joined this week by the original three. I'm joined by Pete and Sean. Welcome back on board, guys.
How are we doing, Luke? Are you all right?
Very, very good. Yeah, good to be back. Sean, happy?
Always happy. New year, new start.
Any New Year's resolutions to share with the guys?
Make better podcasts.
That'd be a good start, yeah.
Making better podcasts. Well, we're trying. We are trying. Actually, on that note, so we've had 5 under our belt now.
Yeah.
And lots of people have said how much they enjoy it, including, family members, friends, which is quite nice to see different people listening to it. But what we wanted to do is we wanted to spend some time breaking into, I think we just added up the number of years worth of trading experience around the table. So I've got 11 years.
I think I was about 16 in 2008.
And I'm about 28.
Ooh.
I know.
The Godfather.
Who can add up? How many years is that? Like 40? 5?
Yeah.
45-ish, maybe even more. And we wanted to use the kind of knowledge that we've got to really help clients break down what it is to trade, right? So we're going to call this series Trade Craft. And we've planned out the next 4 to 5 episodes where we're going to break into things like bias, into news, into sentiment, and things that we hear clients talking around quite casually, but actually, what does that mean? So today's episode, we're focusing on all things trade analysis. So on the IG platform, there's a tool that says Trade Analytics. You can dive in there. We give you all of your trading data. We wanted to sit here and define what all of that means, why it's important, and how we can use it.
Mm-hmm. Yeah, I think it's been one of the sort of best tools that we've rolled out in the last couple of years is certainly that trade analytics piece, because it gives clients the ability to actually see their realized P&L over timeframes that they want by product, and actually dive in and do that sort of analysis of going, okay, yeah, I was doing really well on this asset class and not so well on this one, or you can spot your win-loss ratios and all that sort of stuff. So it's the good old-fashioned David Goggins accountability mirror. Some people don't want to sit in front of it and see it, but realistically, if you're going to be good at trading, you've got to look at what's gone wrong as well as celebrating and high-fiving the wins, right?
Completely. I think as well, to borrow the tone from our friends over at Tasty's whole mantra when it comes to approaching trading is to be completely ambivalent to what the underlying is. It's math. It's probabilities.
Math.
And I think that's really key when you start to look into some of the stuff we're going to talk about, because you could flip a coin and you're going to make money 50% of the time. In theory, trading is easy. You log into an account, you fund a brokerage, and you press the buy button and then press the sell button.
Easily accessible, yeah.
Not easy to get right,
yeah,
but it's easy to do. Okay?
Yeah.
So how do you get it right? So the things that we're going to talk about, risk versus reward. What does that mean? Again, every trading book talks about it. Your win ratio. Then we're going to talk about sizes. I think actually what's probably quite important as well is setting goals. And again, the accountability mirror. How do you actually hold yourself to account? So it's my job to try and keep these 2 strict timings, and then we can rattle through this because there's quite a lot. So we'll start with risk versus reward. Who wants to start with risk versus reward?
Yeah, fine. So basically, yeah, I mean, if we're looking at risk versus reward, we're sort of going, what do we want to lay out, and how much are we willing to put down as a percentage of the account relative to how much we want to make? And I think a lot of clients, they'll go into the positions and they'll go, well, maybe don't have a clear exit or entry strategy. And if you're a technical trader, I think it's easier because you can go, I'm going to go in at this level. And if it gets to here, technically the chart should do this and I'll come out at that point. But if you're trading on fundamentals, price action, et cetera, you can be a little bit directionless. Well, directionless maybe is the wrong phrase, I don't know. But you can lack a bit of structure to entry and exit. So if you've got a risk-reward ratio, you could use something like 1 to 2, 1 to 3. And what I mean by that is that you may be risking 1% of your pot to try and make 2%. Or risking, say, if you've got a 20 grand account, you might risk, say, £500 to try and make £1,500, 1 to 3. Et cetera. So I think it's an important one, and I think it's one that people need to sort of think about before they do enter, and kind of try and stick to it using stops and limits.
It's so key.
Yeah. And I think people often come in or start with unrealistic targets. Still say I want to make, whether it's 10 grand a week or something like that. There's no reference in terms of their risk to reward ratio in terms of their trading experience, the planned strategy, market conditions, because all markets are different, not just the overall general tone, like with Trump coming in now is a good example, but within that, markets, different asset classes have different characteristics. So I think there needs to be an element of that, all of those things built into your sort of risk-reward profile.
Well, I think as well, for me, one of the bigger things that contributes to why trading is the most difficult is because I think people get into it expecting that they're going to be able to make lots of money, when in reality, trading is about minimizing losses, and it's about managing losses as much as it is managing winners.
Preservation of your pot, isn't it?
Oh, completely. Well, a client of mine, what changed my kind of trading life was, I can't remember whether it was Chris Beecham or whether it was a client of mine. He said, the market doesn't owe you anything, right? Doesn't care who you are, whether you're awake, whether you're asleep, whether you're driving, whether you're putting the kids to bed. It doesn't care whether you've got the trade on, whether you've got it on in the right size, whether you've got stops on or not. The market doesn't care. It doesn't owe you anything. The market is effectively this collective thought and kind of valuation machine between every single individual that's looking at the price of the FTSE, the price of spot gold. You can imagine how many billions of people look at the price of spot gold for their own different reasons. Jewelers, wholesalers, people that are speculating, people that have futures contracts. So why do you think you've got an edge in this market? And the chance is we probably don't, at least not when you're starting your journey. So the one thing you can control is how much risk you're taking on. Because if you put a stop loss on to risk 50 points, you can lose 50 points. Sure, you can guarantee that stop using one of our insurance products.
Yep.
You might get slipped, but by and large, you said a 50 point stop, you're going to get stopped out 50 points. And you can control that. Can't control if you're going to make money or whether the market's going to move in your favors. You can control that.
Yeah, I think that's the biggest issue if we're looking at this as a sort of theme of podcast, is certainly for retail clients, is just not focusing on those losses. Everyone focuses on the profits, goes against them, then almost inaction, ignore it, close the laptop, I'll come back and I'll hope. And hope's not a strategy, right? It's not a strategy.
Ostrich technique, isn't it? Bury head in the sun. And hope. When hope is your trading tool or your last trading tool, you know that you're done for. Right?
I remember seeing a documentary. This is going back, about 10 years ago, where they were following a handful of retail clients. And they're sort of 4 or 5, and they're following their journeys. Yeah. And one of them, literally, the trade went against them over like a non-farm, and they said, "What are you going to do now?" And they had no plan for the downside, and they literally went, "What I'll do is I'll close the laptop, I'll make a cup of tea, and it'll be all right." It's like, no, that's the time when you should be focusing.
That's the classic, we looked at like psychologies and stuff and what's dangerous. And that is the dangerous psychology of going where you effectively become a punter and you go, right, I've done no research. I've got it wrong. I'm going to leave it or I'll double it and then I'll go away, and you come back and all of a sudden you made money. And then you get that positive reinforcement in your brain that what you've done is the right behavior. So psychologically, you go, oh, easy, I've cracked it. This trading lark's whatever. And you do that a couple of times.
Yeah.
You then build a little sort of confidence.
Yeah.
That you've got it nailed, and you will get slapped and beaten and hurt by the market because you haven't respected it. And the whole respect thing is have a risk reward ratio or a risk parameter or a stop. I mean, Axel, our in-house analyst, he always says trade with stops. And so many clients I speak to just don't use them. I've never used one, never put one on, never tried it, never put one on. Or stops are for buses. You can't that old adage.
Yeah.
And we all joke about it and stuff. But realistically, if you want to preserve your balance and not be on screen the whole time, you need to have risk management.
You've got to balance ambition with realism.
Yeah.
Right. When typically the clients that we see trade such short time periods, you're inviting so much randomness, and it comes back to this point that math is the most important because you're inviting randomness. Who knows what the pound against the dollar is going to do in the next 30 seconds? No one has a clue, right? It is pure chance. So imagine when you're placing that trade, running a simulation of 20,000 times, right? If you're going to run 20,000 simulations, which we can come back to because we do have a simulation that's worth sharing with our listeners. How many times are you going to be lucky and get it right because you've shut your laptop and you've doubled your size and you've gone out and made a cup of tea? That is not a strategy. It's not. And the chances of ruin go through the roof when something like that happens.
I think that's what clients need to be aware of. That risk reward ratio is effectively saying, okay, well, how many losses will this win cover? That's what you need to get comfortable with as well. You if you've got your risk management correct, there are a certain amount of losses you can take that can be corrected by one win. And that is that ratio. But sort of preparing for this, I hadn't really thought of it until you just mentioned it then. But that overconfident. No, sorry.
You didn't prepare.
Well, a little. But the confidence, the overconfidence is a problem. And it hadn't dawned on me until you mentioned it. But the amount of times you see people win, have a good experience at first, and they get overconfident.
Yeah, and then they size up.
And the strategy, they rely less on a strategy. They even sort of dismiss it entirely. So I think that overconfidence is key as well.
Yeah, I completely agree with you. So let's move on then. So we've figured out that having an idea of 2-to-1, 3-to-1 risk reward, i.e., you're risking the £500 to make 1,500, make 2,000 or 4-to-1. Those kind of things they're in your control and they are slightly, you can start to try and bend the probabilities in your favor. Now, the next part to kind of build on top of this is the concept of a win ratio. So if you were flipping a coin, the 50-50 chance is a 50-50 win ratio, right? So I'm going to give you a quick quiz. So I think when I speak to clients, there's an expectation that some traders are just born for this, right? Some people are just the most amazing people in the world. You start to ream off some of the most famous traders in the world: Stanley Druckenmiller, Mark Minervini, Ray Dalio. All these guys. They've got these mythical powers. Can you guess what Ray Dalio's win rate is historically, going back years?
His win rate.
Yeah. So
I would say his win rate is quite low, but his risk management is very good.
Yeah.
So I'm going to go mid-20s, maybe 30.
So losing more than he makes in terms of
trades, yeah, absolutely, yeah. So he wins 25, 30% of the time.
Go
less.
50%.
Bang on 50.
Really?
So he loses every second trade.
Yeah.
Yeah, he's one of the most successful money managers of all time. Stanley Druckenmiller has 30%.
Yeah.
And Stanley Druckenmiller's never had a down year.
Yeah.
So that's the thing.
Yeah, that's his whole shtick, isn't it? Never had a down year. So I was just looking at my on my IG platform there, and the risk reward ratio we actually put on the chart.
Yes.
So if clients have got stops and limits already in place, and you right click on the chart and show your open positions, you can actually toggle with your risk reward ratio. So if you're unclear as to what that is, you can actually tweak that around.
Yeah. Well, top tip.
Yeah.
Put the trade on.
Yeah.
You can actually, the platform will let you put the parameters in.
You can pull them, yeah.
And you can graphically drag and drop where your stop is and where your limit is going to be to target profit.
So Druckenmiller's a beast.
Druckenmiller's a beast. 30% win ratio.
Yeah.
So how is it then if you're only winning a third of the trades that you place, or in Dalio's case, you're only winning 1 in every 2? Can you actually make money as a strategy? Because that's what clients say all the time. You know, if it's a coin flip, well, then I'm not making money or losing money. Well, the idea is if your coin flip is married with a 3-to-1 risk reward,
Yeah.
you're winning every second trade, but the one that you win pays for 3 losses.
Yeah.
Yeah. And that's the beauty of it, isn't it?
And that's the beauty of it. And then even as we're just talking about these very basic numbers, we're not talking about a better market to trade, a better stock to look at. We're not looking at a better, is US crude better than Brent crude? We're not doing any of that. We're just looking at the math.
Yeah, it's that old, to use a casino, is you want your biggest bet on the table when you're going to win, right? So they're comfortable taking those losses. That's what clients have to get comfortable with. It didn't work out, draw a line under it, limit my loss, next trade.
Yeah.
That's what they're very good at.
Yeah. So many people we speak to who just don't take a losing trade.
Yep,
Will
absolutely.
not take a loser. If you look at their trade analytics, it'll just be profitable trade after profitable trade after profitable trade, and then you look at their open positions.
Yep.
And you go, well, hang on, you're holding quite a tangled web here.
Yeah.
And there's a big running loss, right? So your trading analytics looks like you're an absolute hero, but realistically, again, that whole accountability thing, you've got to go. You've got. It's not a true reflection. You need to be looking at it all and managing that risk accordingly. And I think, to your point there, it's really interesting, that risk reward ratio. Like you say, you can afford to be wrong.
Yeah.
And most people are wrong. And there's nothing wrong with being wrong. But on the ones that you're right, you let it run and run and run.
Yeah.
We need a rebrand. It needs a rebrand. It shouldn't be being wrong. It should be selectively taking negative P&L. That's a really kind of technical way, but it almost need a rebrand. You shouldn't be able to say that I'm wrong. It is a conscious decision that you're making to protect your account against the market not suiting your strategy at the time.
Yeah. Well, it's just not worked out.
No, it's just not
the plan.
No, it's not your time.
That's how I say it when I talk to my clients is, you got to look at it like, that one was incorrect. How many incorrect trades can you have before you're proved correct? Because often people's strategies are quite good, but they trade them quite poorly. And again, it goes back to risk management, risk reward ratios. But again, most people call it well, but trade it badly.
So I had a client of mine who had a strategy running pre-COVID. He was a trend follower. Okay, so his whole shtick was, I don't particularly care what I'm trading as long as I'm following a trend. So uptrending markets, downtrending markets, etc. So he had an idea where he'd put a very tiny position on that he called a pilot trade. And so he'd run like 10 pence per point, a really small trade with a very fixed stop. And 9 times out of 10, that position is getting stopped out. And that's part of the plan. But if that market trends, so let's say he's bought the DAX as an example, and he's been stopped out, he's been stopped out, he's been stopped out, he's been stopped out. So you've lost 7 trades in a row. But then all of a sudden, the DAX kind of breaks its daily high. He then has a trigger to say, right, now there's potentially a trade coming in, there's a potential trend. I'm going to buy in more in a slightly bigger size. And what I'm going to do now is I'm going to move my stop loss up on the small pilot trade to my average break even between trade number 1 and trade number 2. And then the market squats back. He loses both trades. What you've done is you've broken even on those 2 trades because of where you placed the stop. Put the pilot trade back on again. And all these things, he was running the strategy for a year. He knew that across a 12-month period, the strategy would pay him money because he back-tested it across hundreds of years. Maybe 30, 40 years worth of data. He knew it was going to pay him. But he was running something like a 90% loss ratio, 10% win rate. He said psychologically, it was really, really hard because I knew I could make money because of what I was trying to do. But it was so painful to have to put this on every single time, knowing I'm going to get stopped out, And in the end, he just gave up and tried to do something else. He said he just could not.
Dream.
Not when they're trading tiny size. Loads of tiny trades. But it was just impossible to continue to keep managing it.
But that goes back to the discipline. So if you've got a good plan and you stick to it and you're disciplined, it will come to fruition. But we know that most clients in that example will go, okay, I bought in here, there's been no breakout, it's getting in my stop, I'll cancel it, I'll move it lower, or they'll add to it. So that's where it goes wrong. Whereas if you can be disciplined and stick to the plan, and like you say, the math, if it works, it works.
I mean, we've got a great in-house example of this in our trade of the week that Axel does. And I know, I've sent it on to a few clients, and I think you have to follow it all year, I think, otherwise you don't get a fair reflection of it. Because if you just pick and choose, you might just pick the ones that don't go right. And last year, on a hypothetical £10,000 account, it returned 31%, doing exactly this. So a stop on every trade, risking I think 2% of the capital per trade, and roughly win-loss ratio of 50%. So getting half right, half wrong. But he turned 31% return.
Yeah.
And that was through basically completely dispassionate approach to the market. Didn't care if you got stopped out. That's part of the process. But if you're getting stopped out, you were protecting your capital.
Yep.
And on the ones you got right, you got them right on a much bigger risk-reward ratio than 1 to 1, probably 1 to 3, I think it was maybe. And then his other bit that he's sort of passed on to us and any premium clients that we've brought in for workshops is just leave that little runner. So if you've got £10 a point and you get to your 1 to 3 limit level, so maybe you're 30 points up, take off 80% and just leave 20 and let it run. And if the trend goes, and if the trend continues, you've got those little runners then all year that could be the ones that hit you the home runs.
It's a great tip. And it's one that I don't see enough people do, and one that's very hard to execute because FOMO kicks in.
Yeah.
And that's an antidote for it. So if you leave on 20% of your position, you bring your stop up to the break even. Yes, you've paid yourself. Congratulations. We're going shopping. We're going to whatever you're doing.
Yeah.
You've made some money, tap yourself on the back. But actually you've then got this kind of little lad running around.
Yeah, and you've still got something to cheer.
Yeah.
Perfect.
Yeah, exactly.
If you've been, if you like a certain name, you don't necessarily have to exit the whole thing. Just because you've gone right. Okay, limits there or take profits there or whatever.
Yeah.
Leave a little bit in. It doesn't have to be 20%. It could be 2%.
Yeah.
What this brings quite nicely onto then is actually sizing. So one of the rules that Axel's system and the way that we built that trade of the week is you risk 3% of your account in each trade, but you're risking no more than I believe 5% in each time. So if one of the positions hasn't been stopped out yet, his secondary position can't be that big because you've got to then build that your cumulative risk is 5%.
Yeah.
And that might be different for each account, right? It might be 10% for you. But if you're sitting there trying to build out the strategy, well, by saying we can risk 5% of your account, it means you can lose 20 times in a row before you blow up, before you lose all of your capital. Now, Axel, through part of the work that he does is he used to be involved with the Society of Technical Analysts, and one of his trading coaches, his long-standing trading coach, a chap called Malcolm Pryor, actually ran a simulation with him that looked at your system's win rate, 30% win rate, 20% win rate, whatever it is, and traded 100 times on one of those rates. And again, it doesn't matter what it is. He ran 20,000 simulations. So you've got a hell of a lot of theoretical trades on this. And they said, if you were running a 30% win rate across 20,000 simulations, there's a 1% chance that you lose 22 trades in a row. 1% chance. And that's across 20,000 simulations of trades. If you look at a 30% win rate, there's a 100% chance it will happen that you lose 9 trades in a row.
Yeah.
So 9 trades in a row. If you stick to that 3% risk, you're going to lose 9 trades in a row because we know that that's statistically true. So 9 times 3%, 27%, a third of your account. Okay. So at a 30% win rate, you're losing 2/3 of the trades. If you're managing your risk, it's guaranteed that you will at some point lose a third of your account over 20,000 trades. And that's losing 9 trades in a row. That's pretty good odds, I'd say. But again, being completely ambivalent to the underlying, being completely ambivalent to conditions, and that's on a win rate where you lose 2/3 of your trades. If you look at a 50-50, so a coin flip type strategy, there's a 100% chance across 20,000 simulations of 100 trades, you're going to lose 5 trades in a row, but there's only a 1% chance you're going to lose 12 in a row. So if you turned up with a 1-to-1 risk reward, right? I'm risking 10 to make 10. That is a coin flip. Over 100 trades, there's only a chance you're going to lose 12 in a row. There's a 1% chance you lose 12 in a row. So this is when you start looking at math.
Yeah.
And it doesn't matter what the underlying is.
Yeah. And I think when clients come in for these workshops and they have one-on-ones with Axel as well, I think this is the one slide that sort of staggers them or knocks them back a bit. Because most people go, I won't ever lose 9 in a row. I won't lose 6 in a row. It's like, no. You will. This is proven. This is a simulation. It's maths. There's this % chance. and they can't argue with that.
No,
So I
no,
think
the
that
law of large
definitely gives them
numbers,
a sort of reality
absolutely.
check.
And like to a watered down version, I suppose, or like a more digestible format. If you've got 10 grand in your account, and let's say you risk 10% on every trade because you've gone a bit bullish, or you didn't really know what you're meant to be doing. So you're risking £1,000 on every trade, right? If you lose 5 trades in a row, which is pretty conceivable given those numbers there, all of a sudden you've gone from a 10 grand account to a 5 grand account. Okay, you've lost 50%. Now, how do you get back to 10 grand from 5 grand?
100%.
You've got to make 100%.
Yeah.
So you've got to be better than
Everybody.
Druckenmiller.
Yeah.
You've got to be better than all the experts.
Yeah.
And you're just starting out, and that's to get back to break even when you started.
Yeah.
You know, so that's the key. I think is that when you look at it like that, you go, right, okay, yeah, actually, why am I risking so much relative to my pot?
Yeah.
You know, when if you look at something on a different, if you're not talking about leverage trading and you're talking about, putting some money in an ISA and hoping to get 4% a year.
Yeah.
A year.
Yeah.
You go, I'm not going to go with them because this one does 4.1 and this one does 4, but you're happy to do 10k into an account and just YOLO half of it in one trade. It's once you start looking at it like that, you go, hang on, well, this is actually this is, I can make good money doing this.
Yeah.
But I can also lose quite a lot quite quickly if I don't have a risk reward ratio.
Yeah.
So risk reward ratio is it's got to be at the backbone of what you're doing.
And it's not. Oh, sorry, I was going to say it's not only the getting back the 100% to get back to scratch or to flat, but you're starting from a less capitalized position, so it's going to be harder anyway. So naturally, you're going to be, and that is a problem. Being undercapitalized, people over in terms of sizing, they're trading way out of size relative to their account. But yeah, that's why capital preservation is key. You're giving yourself the opportunity to trade again and make money. Whereas if you wiped out half your account in one trade, you're struggling.
Yeah.
Let's use that 10 grand account example, right? But we talk about position sizing because I actually think position sizing is probably one of the biggest killers of retail accounts. People just go, way too, way too excited. They just lose all control. You've got a 10 grand account, and let's say we're working to a 3-to-1 risk reward, and we don't want to miss more than 3% of our account. So I've said the word 3 there. So 10 grand, we're not risking more than 300 quid.
Yeah.
Start with your stop loss. Let's say you're looking at the FTSE. The FTSE at the moment, when we're recording this, is on a bit of a tear.
Yeah.
It's at 85.30. Let's say you don't want to be in it. You're long, you're buying. Your stop is at 85. Okay. It's a
Never put it at the round bigger. We're guaranteed to get stopped out.
Stop hunters there.
Okay. Call it
84.99.
84.50 just to make it easy. Right. So buying at 85.30.
Yeah.
That's an 80 point stop.
Yeah.
Okay. You're risking 300 quid because we know 300 quid is our risk. And I can't do that maths.
£3.50 roughly.
Yeah.
Well, I think I'll do it, but I think it's.
So we're risking £300 divided by 80 points, £3.75.
Ah, there we go.
There you go.
But I would have got it right.
But that
would have got it right. Yeah.
that is how I would build a trade. That is exactly how I would do it. But you're right. So many clients don't do that.
Yeah.
So many clients just.
Yeah. So then you know your amount per point. You know where your stop is.
Yeah.
You've got your risk sorted.
Yeah.
Then all you got to think about is what do I want
my
to be
limit.
rewarded for doing this, and where's my limit going to be? Do we do it 160 points? Do we do it 80 points? Do we do it 240?
Yeah.
Do we do it 320?
Good maths there.
8 times table.
Yeah, I like that.
I got it wrong. And that's exactly where it comes from. So now we're kind of starting to put this all together now. So your P&L, the risk that you're putting on per trade, your 3%, your 4%, whatever it might be, is the first decision to make. We could look at the simulations for figuring out what your win rate, how kind of your simulation is in terms of how many the trades you can afford to make and lose in a row. You decide you're on a 3-to-1 risk reward, then set your stop. So before you even look at the market, in terms of opening, look at where is the market telling you that your idea was wrong? Or where are you playing defense is another way to think about it. The market is not what I was thinking. I'm playing defense. Here's my stop loss. Right, great. How far is the stop from the current price? In this example, it was 80 points. 300 quid divided by your 80 points is £3.75. That's your optimal position sizing. And that seems so easy to say. It's so difficult.
We all know the rules, right? We all know what we should be doing, but it's so hard. And I mean, there is a case that building that out, if you want to focus on anything, focus on the limit. Do not focus on the stop, because when it gets close to it, you'll start tweaking it, you'll start moving it, you'll cancel it. Do not move the stop.
Yeah.
That has to remain. There's a case for us to go, we offer stops, guaranteed stops. How about a non-cancelable or can't cancel stop? Once it's on, it's on. Imagine that.
The handbrake.
Yeah, handbrake stop. Yeah.
No, it's interesting. And you say there, like, we all know that you're meant to do these things, and we can sit here and we can talk about doing it. And, for the benefit of our listeners, it's hopefully helpful to know what the book says and what we've seen and the experience of what we come up against when we're speaking to clients and common pitfalls. But yeah, realistically, even with the experience you mentioned at the start, we still fall foul of these rules.
Yeah,
sometimes.
absolutely. Yeah.
And the one that I think that really trying to get better at, which we'll probably touch on in the next episode perhaps, is the add to your winners, not your losers.
Yeah.
And so many people
absolutely,
add to their losers.
Yeah.
Averaging in. I'll buy more. I'll get a better average price.
Yeah.
I'll get my price lower to being break even. But realistically, what you're doing is you're compounding your size up to, you were happy with maybe £10 a point, all of a sudden you got 50, and the direction of the trend is obviously against you because that's why you have averaged in. So now you've got a position 5 times bigger than you ever wanted, fighting a trend.
Yeah.
And the inverse of that, and what Axel always says in the things is add to your winners. Exactly as your man was saying earlier. Get to that point where you've got that pilot trade, it comes right, stop goes up to break even on that bit of risk, and then we add more, risking the same, and then you've got it right.
And it goes back to when we appeared on Garth McKenzie's podcast. We touched on it then about starting small and wide. So in this point, whatever it is, 80 points. If it goes in your favour, you get big and narrow. So you add to it, but your stops get tighter. Because if you keep the same distance and you're adding in size, you're only ever going to sort of give it all back. So I mean, I don't know, if you start in £1 with a 250 point stop, goes in your favour, it's 150 points your way, you might add £2 stop with a £2 position with a 100 point stop. Goes again, you had £3 with a 50 point stop. So you're adding, your position's getting bigger, but your stops are getting narrower.
Yeah, you're controlling your risk as you go up, and you're building this nice, bigger than start trade in the direction of travel.
Yeah, absolutely. Yeah. And to your point, naturally, most people do the opposite.
Yeah.
So it's hard.
I think that rounds that type of discussion. I mean, it's been quite heavy. I think the thing that we need to define is, what does a goal look like, right? When you're setting up and trading, how do you know if you've been successful or not? So does Stanley Druckenmiller sit there and go, oh, great, I've made gazillions, whatever it might be, that was my target. So to ask both of you then, when you're trading, do you want to make a certain amount of money per week, per month, per year? Or do you want to be better than a specific index? And the reason why I say that is when you look at, as IG now, we've got so many different types of products that investors, traders can take access to. If you're investing, you want to perform better than your benchmark, right? Otherwise, what's the point? You might as well just buy a tracker. So in trading, it's probably quite similar. If the S&P is up 20% like it has been for the past 2 years, you're down. Why did you not just buy the S&P? Very easy to say that with hindsight, of course, because the markets can go up, can go down. So why don't you have your pot of capital in your IC, your non-leveraged pot that is the market, and maybe then you use your discretionary pot to try and amplify that. So to ask both of you, do you want to make specific amounts of cash, or do you want to perform like a percentage? How does it work? What's on your experience?
My experience, when I've been sort of trading actively, I'll always look at a certain amount of points per day, and that's what I'm comfortable with. So I'm willing to risk whether it's 100 points to make 300 or 400 points. That is where I start. And then the size is irrelevant, because I think if the strategy works, I could trade £2 one day, I could trade £3. It's not ever really going to vary in terms of stake too much, depending on the performance. But for me, it's about consistent and being disciplined. So I think mine is X amount of points, whatever that is. Yes, always. But rather than percentages over the year or outperforming, it's just being consistent, certain amount of points a day, both up and down. And that is a good point. I don't know if we'll get onto it. Is what do you do once you've hit your financial goal? If you're that short.
Well, that leads into what I was going to say was, over the years, I've tried different things. For a time, there was a period where I was just trading UK Open, FTSE mainly, and I'd want to try and make a certain amount. If I hit that amount, that was it then. Wouldn't do any more. I'd whip it off the account, and I wouldn't start again until the next day. And then, do that for a bit, and it was kind of working pretty well. But then, obviously, as a human who's flawed and greedy, something else shiny catches your eye, probably a stock, and then you got involved in that, and then all of a sudden, you've given back what was going quite well, given back onto that. So I think losing focus of if something's working well and it's doing what you want to do, and you're hitting that goal, stick with it. Yeah, don't start all of a sudden go, this pharmaceutical stock sounds interesting. Yeah,
don't start chasing
I know
it.
nothing about
Yeah. And it's hard.
So that I think is key. And then I've changed now really to I probably look at like a quarterly, 6 month, and yearly. Messaged my account manager and say, because I don't have trading analytics to my fingertips, which I would love, but and say, right, where am I at? And there's no goal as such other than ending the year with more than I started with, and making as much as you possibly can, basically. And there is no stop as such. So if you have had a good, successful run at it, I wouldn't stop doing it. I'd go, right, well, what I'm doing at the moment is working well, so I'll keep doing it. And I've been speaking to one of my clients a lot recently who's had a really good run of form over the last year and also the start of this year. And we've had lots of conversations about, you've made such a substantial amount of money in the first couple of weeks. You could, in theory, just chill out now for the next 2 weeks. And then, the conversation went down the line of, well, I just feel like I'm reading and seeing things so well at the moment.
Why stop?
Why stop? Yeah. And, fair enough.
Yeah.
It's completely up to the client. But it's good to have those conversations where you can say, right, okay, actually, you take a step back, you go, that's a good amount of money in a short time frame.
Yeah.
You could give yourself a break.
I think as well, you've got that person to bounce those conversations off, right? I don't know if I speak for people on here, but I know that my partner, my wife, doesn't really give two hoots about, how I would be conducting myself. Of course, she'd care if I lost loads of money, but not having someone to be able to bounce those ideas off. Like a client of mine says that, he doesn't speak to his friends about the investments and the trades that he doesn't do.
Yeah. We find that
we're the only person. We're the only people that they can.
Yeah. So we find that when we do group events, like group lunches, group dinners, and you get
they love that.
A collection of people together,
share stories,
and then one of the common interest is markets and trading stories. All of a sudden, all of that it creates a great atmosphere because people can talk about what's gone well, but also what people typically touch on is what's been going badly.
Completely. Well, because we've just spoken about, right? The whole thing we're trying to do is normalize.
It's that.
We're trying to normalize that losses are part and parcel of trading.
Yeah.
And actually, they're probably the only thing you can manage because stops exist, right?
Yeah.
If the market goes to your stop, you can control the brokerage platforms that you work on will take you out of those trades. You can't control whether you're going to make money or not.
Yeah.
You can just try and, hopefully.
You're right in what you said earlier as well. Like when you first said it, I thought you maybe being slightly woke in terms of saying something along the lines of, let's not call it taking a loss or getting it wrong.
Yeah.
But what you actually mean is let's make getting it wrong part of getting it right, as in
getting comfortable with it.
Yeah, let's make loss to make way bigger gains, as in like you have to make some losses. You have to take some losses as part of the process of putting in place a risk-reward ratio. And if that, like you say, that's proven over time, even if you lose more than you make in terms of trades, winning ratios, you could still end up, probably will still end up with more money at the end of the year.
Yeah.
Completely. It's almost like a working capital investment, isn't it?
Absolutely, yeah.
You're a business. A business has to go and buy its building, has to go and buy all this stuff that it is losing money on. If you go and acquire a company, you're buying stuff in the hope that it will continue to pay you profits to then pay off overall so that the trade works out. It's exactly the same thing. It is exactly the same thing. So we're shortly coming on to the favorite part of the podcast. But let's just round up what we've been talking about. So to summarize, for a successful client, in our experience, what makes good traders and bad traders? Define your risk versus reward and stick to it. It is
pre-trade.
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 Agree. Pre-trade. It comes down to maths. It comes down to probabilities, and it comes down to trying to kind of turn the table in your favor a little bit by using risk versus reward. know what your win ratios are, and know that what it actually means. 70% win ratio, yes, it means that you're either the messiah, but it probably means you're just not actually taking your losses and being honest with yourself. So look in that mirror and be accountable. Sizing, position sizing should be a function of your risk and account size. And that's it. That's, sitting there, we were chatting earlier, Sean, actually, you've got a client that buys 100 quid of something and then 100 quid of something else, then 100 quid of something else.
Yeah.
But all those different something else's are different prices.
Yeah.
So the notional size of your trades are all over the place. How on earth do you control risk?
So I want to buy 100 quid of Barclays, it's 30 grand. I want to buy 100 quid of Rios, it's 500,000.
Yeah.
No, but like they're the same thing. But that's the common mistake, right?
Yeah.
People just
Very common mistake. So sizing is a key part of it. And then, goals, I have to work on myself because I'm a little bit goalless when it comes to it. I'm grateful to make any money sometimes as opposed to trying to make losses.
on the goal setting. What I would say as well, we didn't touch on it. It kind of going back to the accountability. Goal setting gives you that accountability. It gives you discipline. I think as well it makes you less impulsive because if you've got like you were saying about a certain amount of points for a day, you've done it. If you didn't have a goal in mind, you just trade again. Whereas I think it does give you a little bit more of a buffer to go, hang on, I'm there.
So harks back to FOMO.
Yeah.
If it is out of your circle of confidence, don't pull the trigger.
Yeah.
The edges aren't there.
And you're less
If
emotional,
you
I
have
think.
it, you go bang the laptop down and go and do some different.
Yeah.
Once you're out of the actual arena, you stop.
Yeah.
If you keep looking, you will see something else you fancy.
I think that's key as well. I think if you're new to markets, I think having that, once you've hit your goal, what do you do?
Yeah.
Whereas I think if you're a bit more seasoned, a bit more long in the tooth, you can kind of have that naturally. Whereas I think a newbie sort of has to have that. What do I do?
Yeah, completely. And all these things, by the way, there are tons of assets on IG's website that can give you all of this. Axel, we've spoken and pumped his tires a little bit, but he's an asset that we have, and he writes content almost every day on IG's website. He's now got a show once a week on the Trade Live with IG show. He is an invaluable resource. I think there's a lot of people out there that, claim to write lots of different things, and analysts. I'm skeptical of them at the best of times, but actually what I like about the way that Axel approaches it is its probabilities.
Yeah, absolutely. Yeah.
And to that end, even if you were looking at what we haven't touched on is options, so defined risk options versus undefined risk options, probability math is exactly where Tasty Trade was built upon the assumption that it is all math and luck should be discounted over every time. And actually, no one knows everything, so it's all leans back to maths.
Yeah.
So there's a couple of things you can go and look at. Trade of the week. I recommend that. I think we've spoken about serious stuff far too long, don't you? Feels a bit heavy, that one. Hopefully it wasn't.
I thought it was quite light myself.
Nourishing.
Nourishing.
Like January nourishment.
Yeah, it's New Year.
Yeah, new year, new us. Look, we're all being serious. So without further ado, let's go back to our favourite part. We are bringing the margin call back. Lovely. So we've been given a plethora of content over the last week, I'd say, because of Trump's inauguration. So who's going to kick us off with this week's margin call? Oh, for those that don't know, margin call is the part of the podcast where we take a little look under the hood of the markets. Who has taken the biggest L over the last fortnight? When we get back to these, we're going to record them every 2 weeks. Who's taken the biggest L? Who's the biggest loser? Who needs to take a look at their own risk management and take them out and stop themselves out? So, chaps, who do you think?
Mine's going to be short and sweet this week. Elon, with his salute, shall we say? I think, it's got to be up there.
It was a world stage, wasn't it?
You've got to know your audience, right? And the audience is the world.
Yeah.
So,
someone's saying it was over exuberant and it stemmed from like the Roman days and it wasn't anything linked to.
And he was throwing his heart to people. That's what he was doing, allegedly. But
it was very.
It was ill-advised, right?
Yeah, whipped everybody up. I got a text from my mate actually last night saying he was like, "That's it. I'm off Twitter. That was the final straw.
Yeah.
I'm off Twitter."
It was a bit of a crazy one, yeah.
It was a bit crazy. The fact he repeated it, I was a bit like, well, maybe wasn't intentional.
Yeah.
But for me, I'm going to go with, Elon.
Not a musketeer anymore.
Less.
Less of a musketeer.
Less, yeah.
I'm going to go. If you've seen the photos, you know exactly what I'm going to say. Mark Zuckerberg standing next to Jeff Bezos and Jeff Bezos's girlfriend, who is Lauren Sanchez. Yeah, Zuckerberg, what are you doing?
Oh, the old
Come on.
cheeky look.
Oh,
The old
yeah.
cheeky look. Yeah, come on. You've been caught.
Yeah.
Own up
Rumbled.
to it. You've been rumbled. You
Yeah.
can't-
Again, the eyes of the world are watching.
Yeah. You can't be doing
You
that.
can't.
You just can't be doing that. He's had this whole like masculine rebrand, hasn't he? With his
Yeah.
with his jujitsu
Apart
and
from his hair.
That's it.
well, no, he's got his kind of like cool surfer hair now, isn't he?
Yeah. Did you watch him on the
Still talks about perm.
Joe Rogan podcast?
I've seen highlights of it. I haven't seen
Yeah, pretty good actually. Interesting, all the stuff they've got to do. But yeah, that was
it. Ill-advised.
yeah.
Ill-advised.
Yeah. True.
And you, what have you got, Pete?
I mean, yeah, I think I was going to go down that route of that one, but yeah, maybe my own poor trading this week on the FTSE and not abiding by those rules. Definitely too much risk versus reward, but yeah, I think I managed to slink out of it. But lessons learned. And I think like Axel kind of says to when you come in for the workshops and such, he sort of says you need to kind of write down what went wrong, and I think that was moving stops.
Moving stop.
I had them in.
Yeah, that's a good point.
Which means you didn't have the bid.
Yeah,
What we didn't touch on is a trading journal.
yeah,
Yeah.
yeah. We can touch on that.
So yeah, we'll
Let's do
touch
that
on that in
next
future. Yeah.
Let's do that in the next
Yeah, yeah.
episode. So, guys, thank you so much for your time. Everybody, welcome back to Talking Shop. It's lovely to have you back. What we're going to do over the next couple of weeks, as we said, this is going to be a bit of a series. So breaking down trading as opposed to talking kind of more about news and everything. So we're going to talk about bias in the next couple of episodes, social influence. Herd behavior, is that something you want to pay attention? Is it something you can generate some edge from? Sentiment, so just in general, again, playing on that kind of crowd story. Things like loss aversion, so how does that impact your ability to think? And then we're going to find a way to pit two people against themselves, fundamental analysts versus technical analysts. So we're going to keep this story rolling. If there's any feedback, if there are any stories that you want us to talk about, anything that you're struggling with, anything that you think is working well, let us know. We're send us a chat on the Trade Live with IG TV show. Ask at IG is the email address that those guys pick up. We're more than available on there, and or give us a ring, and we'll happily have a chat with you.
Yeah. And I think for everyone listening, and Pete, know your plan, follow your plan.
Yeah,
That's it.
stick to it.
There you go. Guys, thank you very much. We'll see you next time.